thank you for attending. This will be recorded. My name's Fred Hubler, and hopefully most of you know who I am. Today, you get two Freds and a Greg. And so, that's something for you. Thank you for taking the time. Nobody wants to pay taxes. And we want to take, 30, 40 minutes to kind of show you Greg Kerr from Mali, our CPA, and a great CPA will go through in general all the different tax changes and things to look out for. And then we'll have Fred from U.S. Energy give us and we can, at Creative Capital, we can do almost any oil and gas type program. And I could have had 3 on this call, but then it would have been like the dating game, and probably you would have been confused on who's did what. So since this is focused on tax strategies, we picked the oil and gas program that we've vetted and are using in our office that had the highest benefit from a tax standpoint. So the other Fred will go over the good, the bad, the ugly. This is not meant to sell it. This is meant to explain it. This is really meant for, and if you ever felt like the rich get richer because they know things the other people don't, this is one of those strategies. It's considered an accredited investment. I bet all of you are accredited because the people we invited, we knew were accredited. And accredited just means $1 million net worth, not counting your house. Doesn't mean you have $1 million to invest. These are not large, super large investments to make on your half from there's not high minimums. But accredited investments are a completely different asset class and have multiple restrictions on who can see it, who can sell it, how to get into it. You can never advertise it. Like, it's a really different world, but it's a world I've been navigating for 22 years. And for the clients that have been with us, they see the benefit of that navigation. The hardest part of explaining someone an investment, they have no frame of reference. So this is just the beginning of sharing a frame of reference and how the wealthy use pretty much old tax codes. And there's a few things that are a common theme with everything Creative Capital sees out in the world. If it works, because not everyone can do it. If everyone can do it, whatever it is, not everyone will do it, and they won't be available for everybody. So I'm going to turn it. So first off, the disclosure, don't listen to anybody. Don't listen to me. Don't listen to anybody. Really what that means is this is meant to be education. If you're interested in U.S. Energy, and I'm not your advisor, see if your advisor does it. This isn't meant to be my Fred show. It's meant to give a frame of reference on how these things work. If you work with Creative Capital, obviously, reach out to us. Happy to go through it, go over the disclosures that we probably won't get time for today. So I've asked Greg Kerr to talk about the overall tax strategies. And I asked the other Fred, to talk about the good, the bad, the ugly of what U.S. Energy is putting on the market. We've already approved it. So the ugly isn't that ugly and the good is really good. And I didn't say anything bad. So that being said, a little bit of who we are. Chief Wealth Strategist for Creative Capital. You kind of know our story. The very short thing is I left Edward Jones, started my own practice in the same zip code as Vanguard 22 years ago, and did alternative investments just to look different. And I tell everyone, blessed, lucky, and smart in that order. 22 years later, we are one of the largest alternative investment. We don't make anything, but one of the largest access points for accredited investors to get alternative investments that are off the shelf, that are FINRA and SEC regulated. And that's been good for us because it's been really good for our clients. It's always about what's about with the clients. I'll let Greg give his bio, and I'll let Fred give his bio when it's his turn. So Greg, I'm going to turn it over to you.
All right. Thanks, Fred. Good afternoon, everyone. I'm going to be going over here some tax law sunsets. A lot's going to change come the end of 2025. And then some of these sunsets also, trigger into thinking about estate planning and considerations you may want to make here. So with the tax law sunsets, 12/31/25, a lot's going to change. So the Tax Cuts and Jobs Act of 2017 really changed a lot of taxes. One of the biggest things being Section 199A. I'm sure everyone here is aware of what Section 199A is as a business owner, and the benefits of this. It's essentially a 20% pass-through deduction for qualified businesses. Most businesses are qualified. Financial advisors, accountants, attorneys, and doctors are not, based on certain income limits. But that deduction is scheduled to go away at the end of 2025. That's probably the biggest change, along with the estate lifetime exclusion that we'll get into a little later. Some other changes here: income tax rates are going back to the pre-Tax Cuts and Jobs Act rates. So the top rates going back up to 39.6%. And then a lot of the itemized deductions are returning back to what was pre-Tax Cut Jobs Act. Some of them are state and local income taxes are no longer going to be limited to the $10,000 threshold. Miscellaneous itemized deductions are coming back into play to the extent they exceed 2% of your adjusted gross income. And some of the most popular ones are unreimbursed employee expenses, tax prep fees, investment fees. These you can come back to itemizing again. There is going to be a limitation on your itemized deductions depending on your adjusted gross income. So, there's going to be some limitations, with being able now to claim all of the state, local income taxes and real estate taxes on multiple properties. Another big change here, alternative minimum tax will return back to its lower, pre-2017 levels, indexed for inflation. But over the, since 2018, we've experienced some favorable tax laws as it relates to AMT. We'll see a lot of these start coming back into play because, certain itemized deductions are add backs for AMT. And what some of the oil and gas investments that will be discussed later, with excess and tangible drilling costs, there's some AMT add backs there. So there are some considerations on that. And you will find most high income taxpayers will be doing additional planning to limit or avoid AMT tax. This change is already occurring right now. It's the bonus depreciation. So that's going down right now in 2024. It's 60%. That's going down 20% each year until it's fully phased out. The House did pass a bill to restore this back to 100%, but it did not make it past the Senate yet. So from what we're hearing, nothing will probably happen before the election, but there are talks about that going back to 100%, which is very favorable for business owners and real estate investors. Section 179 still is in existence, but there are limitations on what you can deduct through Section 179. Another big thing, it's a current bill that's out there as well. It also passed the House, but not the Senate, is what's going on with the R&D credit. A lot of companies have abandoned taking this credit because of the rules with Section 174 and having to capitalize your R&D costs. It has it creates a significant tax burden in excess of the credit in the first many years. So there is a bill in place to restore that back, where you do not have to capitalize those expenses. That's still up in the air as well. Another sunset after 2025, after 12/31/26, qualified opportunity zone deferrals of gains by investing into qualified funds is no longer allowed. And then the biggest one, which we touched on earlier, is the estate lifetime exclusion being cut in half. So the exclusion now is about 27 million for married couples. So that will get cut in half at the end of 2025. So estate tax planning is something that's, on the forefront of everyone's minds right now. Revisiting wills and gifting strategies for high net worth families to transfer wealth before the lifetime exclusion is cut in half, to get grandfathered in at the higher thresholds and make significant gifts. So there's strategies. There's no silver bullet for everyone, whether you're creating, grats or slats in certain trusts or family limited partnerships, putting life insurance policies into irrevocable life insurance trusts, as life insurance is income tax free, but it is not estate tax free if it's not through the proper trust. As I mentioned, gifting assets to lock in the exclusion at the higher limit, and then also considering, valuations of certain assets to achieve discounts, as the IRS allows discounts if certain investments are held within entities where you value the partnership or ownership interest or equity interest of the investment, where you can achieve certain discounts that are allowable as a lack of marketability, because they're not publicly traded, entities or lack of control if you structure it properly. So, if, estate tax planning is a serious consideration. The step up in basis is still in play. That was threatened to be taken away a few years ago. So even if you're under the estate lifetime exclusion, there's benefits to having higher values to get step up in basis, depending on your estate.
With the next slide.
Yep, you can move through, Fred. So this is a lot of the expirations we sort of touched on right here. There's a lot of talk about with upcoming increased corporate tax rates. Most individuals and closely held companies are not C corporate structures. You'll find most of them are pass-through entities. And the reason the corporate rate was reduced down to 21%, well, the reason we had Section 199A was to give a break to those that were not C corporations. So I think we're going to see income tax rates going back up. And the larger standard deduction, as I mentioned, that's going to go back down to normal. However, there is some allowance here with being able to itemize more. Here's a slide on the current capital gain rates. There were threats, with the current administration in regards to whether they were going to tax long-term cap gains over certain thresholds at ordinary rates. It's a consideration with a lot of investors that have long-term assets with building gains and deciding whether they want to, cash in, pay the tax now at the current rates with the threat of potentially these rates being ordinary over certain income limits.
All right. So
that was all I had, Fred.
All right, that's perfect. So yep. I have two superpowers. One is to forget your name the minute someone introduces themselves to me. But the other superpower that's actually helpful, I think, is taking something very complicated and making it simple for people to understand and make decisions. And with taxes and CPAs, I think there's two kinds. They're the kind that keep score, and they're the kind that can play the game. And as you just heard from Greg, if your eyes didn't glass over a little bit, then you know more about this than most people. But most people are like, oh my God, it's a lot of stuff. No, it is. There's more pages in the tax code than the Bible. And then I don't know if, it's probably not good for anybody. So if your tax person isn't like a Greg, go find a Greg. You don't have to use my Greg, but go find someone that can help you navigate, because taxes are not going away. We're never going to go away, and probably going to go the opposite direction of away. And if there's ability in the code to pay less in taxes, that's where the CPAs come in. That's where people like us come in to do strategies. So I'm going to turn it over to Fred from US Energy, and then we're going to turn off the slides. We're going to answer any questions. If you have any questions while we're talking, put them in the chat. I don't see them right now because I'm seeing what you're seeing, but we'll go back to the questions, and obviously, I'm going to answer any questions. This will be recorded. There is a PPM. So if you are a client and you want to see the guts of what Fred's going to talk about, absolutely happy to do that. Not the purpose of this call. This purpose is educational, but obviously if you're interested and want to see, under the hood, we're happy to do that. So I'm going to turn this over to Fred. Fred has his own do not listen to us. A lot of lawyers are involved with any kind of future, presentation or public presentation of investment. So at the end of the day, this is education. We're not here to sell it to you. So don't buy anything until you get educated, get the information. Fred, take it away, my friend.
Perfect. And yeah, that's well said. The lawyers never run out of ways to move commas and do seemingly menial things to justify their existence. So with that, and I'll just I try to get through some of the boring stuff quickly, like us and our history and all the stuff that I just really want to get kind of out of the way and focus what hopefully is more meaningful to the group on the tax planning side. So it's still somewhat important to highlight, right? The really quick version on us is we're about 50 years into this. So we're a privately held, family-owned oil and gas investment firm. We are the largest provider of these kinds of assets in the nation. To give you an idea of what that means, we will raise and deploy about $1 billion this year through various different verticals and different structures, all of which are in some regard tax related. But we're a little unique in not just our size, but also the way that we're structured, right? So we're structured in a way that we have more than just a single style of funds. We have several. We have several share classes within those funds, and also the ability to work with not just qualified dollars, but also non-qualified, really meaning before and after tax. And what this allows our advisors to do, our partners, is when they're going from one meeting to the next or one call to the next, everybody's needs are different, right? One meeting could be with someone that has a massive income year and they're just having so much tax pain that a drilling fund is something that could be, and we'll get into this, a very important part of their tax strategies. And the next meeting, it could be something totally different, where someone, and I do a lot of this on the side, working with someone that has big exits as an exit planner, they're looking for capital gain plan. So there are all kinds of different ways. Part of the reason, guys, is that, and why we have this, is there's so much overlap in the tax code in my sector, right? So energy, or oil and gas, to be more specific, has a massive amount of overlap, and it really gets into the esoteric rabbit holes of the tax code. Our job is to bring a lot of this surface level in bullet point format, but in general, that's really why you're seeing a lot of these tax slanted styles of assets that are also in the energy patch. So what you're looking at here is a map of all of the bigger red regions, or just all the prolific basins that are out there. Most of what we do, most meaning about 90%, are going to be in that green shaded area, which is Western Texas in the Permian Basin. Not that we don't have assets in other areas like the Anadarko or the Williston Basin in North Dakota. We do. We have 5,000 wells across all these areas. But the vast majority, about 90% of what we've done for the last several years, 6-7 years, have really been in the kind of the core of the Permian. And there's a lot of reasons for this. But what we've really found, and I put this out there, guys, to give you a little bit of a flavor of how we run these models. What we found with this is it's not just the best performing rock or shale that we've ever produced, meaning economics are good. It's what our investor base loves, which is it's the most predictable. So bottom line, if you remember nothing else from what I say, I would just remember this. We're about two things, right? It's bringing clean, above board tax benefits to investors through different various fund structures. And from there, having predictable cash flow. Our investor base really wants to see manufactured yield over and over and over. And they want to see consistency. Prices go up, prices go down. They want to see that over time. And that's what we bring to the table, right? So we're not the highest risk player in our space. It's not the sexiest thing in the energy sector, but it's a bit more boring or vanilla than that. But that's what our 40,000 investors and $4 billion that we've raised in our history have really demanded from us. So the point being is, if someone really wants that sexier exotic stuff, that's out there. It's just not our risk set. Now, and part of the reason, and you're looking at some of these examples on the slides here of why we've kind of seen this asset morph into more of this predictable cash flow monster, if you will, is that we have stepped away from, for the most part, of drilling our own assets. So for years in the oil and gas sector, you would literally see a company take their own inventory. What acreage do I own? And then pair that up, right? They'll go out and raise capital and bring those two together, and they'll make a business out of that. And that's something wrong with that. Is what we've actually found much better economics in leveraging other people's assets. So for an example here, we only operate, I shouldn't say only, about 90%, 85 to 90% of what we operate, it's not even our own acreage. We happen to have access to some of the acreage with the publicly traded majors. And you're looking at the names, Devon, Shell, Chevron, you can read them here. And because of that, their stuff is just so much better than ours. It cash flows faster. It comes in tighter to type curve, meaning it's more predictable. It's easier to hedge out so we can de-risk future prices. It's all the things that our capital base has really wanted for years. So we actually don't really we don't really develop much of our own, about 10% of our own assets in each fund. The lion's share tends to be that of one of the majors. And so what this has led to, if we can go forward one slide, I think is next. I don't have the button here. You can go past this. That last slide was actually someone that was there. Yeah, we'll touch on it. I think this is important. Any due diligence that you're doing in any fund, I think it's sometimes good to ask the company, hey, is the chef eating his own cooking, right? We're the largest investor in everything we do. So last year is about 130 million that we put in the same assets and funds that our investors are in. This year, the same structure, just bigger, closer to 200 million that we're going to put in for the different funds that we have out for this year. So as far as alignment, I think that's always a good indicator that you're seeing the company behind the scenes putting their money where their mouth is. So we can go back, we can go past this slide, please. What investors look for, right? So I'll just touch the very high level and keep this high level. What are drilling funds and what do they do, right? So there's two parts. One, the investment year, right? So 2024. And then that's part one. Part two is 2025 and forward, right? So again, right now for this year is part one. Part two is everything after this year. So for this year, investors are going to get an upfront tax deduction, right? And it's just on a percentage. I'll just use $1 for easy math. They will be able to write off about 90 cents or 90% of the dollar they put in against any kind of income. So what's fun is that for the CPAs, these are above the line deductions. And they're also what we call non-preference items, which is really good because if you're doing other things with Fred for tax planning, this works with them, right? So it works with AMT. It doesn't work against you. And the cool part, that's just on the way in. So you get this big deduction on the way in, but you also get tax advantages on the way out, right? So you're not just getting the cash flows from the assets, but you're also getting some tax benefits. Some of it's tax-free, some's deferred, but you get a lot of tax benefits on the way out as well. So those two things are typically not together. Sometimes you find them, but they're mutually exclusive. In the drilling fund world, they're actually combined. Tax benefits on the way in and on the way out. The way that we construct these is everything's on a quarterly basis. So we will have cash flow that begins in Q1 of next year. And I'll show you some examples as we get through here, but it's a way for that's what they're designed to do. Drilling funds are designed to get a deduction day one and then to send cash flow back out as fast as possible. So with that said, we do have to get to a point where we want to raise capital, develop assets faster. We do have early investor incentives that are out there. And here's a quick snapshot to what those look like, where investors the earlier they come in, the better terms they get, right? So these are basically tied to what we know as preference items or preferred returns. So investors could get as high as a 20% pref, or in other words, they have to see 20% a year of cash flows until the company makes its money, right? That's what a preferred or a pref is. Or it could be as low as 12 and everywhere in between. And the timelines are in front of us. It just depends on when they come in, right? So the lowest preferred return will be a 12%. That's there per year, and the highest 20, and then everywhere in the middle, just depending on the timing. Well, if we can go another slide, or do I have okay. It's also important too to look at and look at how are things tracking versus, so I see this a lot, especially in our space, where someone will have this model and say, well, we expect this asset, right, to pay out X over Y number of years. And they'll have all these models and assumptions and whatnot. And that's a good question, or I guess a good statement, but it's also very important to look at what actually have you done, right? Don't tell me what you think you could do. Show me what you've already done. Those are very different discussions. And you want to have both of those, right? You really want to look at both of those and then make your own assessment. So why I'm saying all of this is we typically tell investors to expect anywhere between a 3 and 5 year payout, cash on cash, to recoup your initial investment, right? So in other words, if you put $1 into a drilling fund, and if we forget all your tax benefits, just put those on the shelf, forget those exist. You should get $1 back in cash flows in the first 3 to 5 years of that portfolio's life. And you'll still get cash flows in year 6, 8, 12, whatever, but you should get a lot of that early, right? And we have some funds that are taking a lot less than that, some that are going to do better than that, but in general, that's kind of the expectation. And it also aligns up with what our track record is. So with that said, it's important and that's why we have cash on cash, which is the second column from the right, and then cash and tax, which combines the two, right? So you can judge it how you want, but that's why when we look at these, you will see very heavy, high cash flows early, lower cash flows later. So in other words, drilling funds are like champagne bottles. It's like blowing up a balloon and letting it go. A lot of cash flow now, they deplete down over time, right? And a little cash flow later. And from that perspective, that's by design what they're meant for. They're designed to reduce tax, and they're also designed to cash flow back everything back to you as fast as possible. So that's really how we've constructed ours. What does that mean in real numbers? Short answer, it depends. But to give you some historicals, I would say in the first 12 to 18 months, you should see between 30 and 50% cash on cash, in addition to whatever deductions you got, right? So if you're an investor in a high bracket in a blue state, odds are you're saving 30, 40, sometimes over California, New York City, over 50 cents day one in tax you're not paying. And then you got another 40, 50 cents in cash flow in the first year, right? So that it takes away that risk pretty quickly, because between the two, it's adding a lot. The bogey's pretty low because you're getting that recycled cash so fast. And you'll start to see that cash flow really continue hot and heavy for the first several years. And then slowly over time, it'll deplete down. And you'll see that probably settle in the mid single digits on a long annuitized cash flow for years. So these can be 15, 20-year lifespan assets, but I would argue it's really closer to 10, because most of that, right, all your volume really comes out early, right, and you have a little volume later. So that's what I would look at in terms of a lifespan, if you will. So one component, right, and this is probably intuitive, because when we look at what do we drill for oil. What's important to us, the price of oil, right? Obviously, this is actually becoming a little bit desensitized here, and a little bit less of a big deal in terms of structure because of hedging, right? So we do a significant amount of price protection strategies in this fund, aka hedging. We can't tell you. I can tell you right now the price of oil is $79, right? Where's it going to be tomorrow, next year, 2 years? No idea. However, I can tell you what you're going to get from the portfolio, because we can hedge that risk out. So because we hedge a significant amount of production, about 40%, that is enough for investors to protect their first dollar. So if they put $1 into the fund, right? And again, we just ignore all tax benefits, put $1 into the fund, and the current price of 80, right? The market deteriorates and prices collapse. We know they're at least going to get their dollar back, even if prices collapse, because of the hedging. So that's a big part. It's more of a risk aversion and on our partners, and that's why we do it. So about 40% or so is going to be hedged out, and then the other 60 or so is going to be at the current strip price, or the what we call floating rates, right? Whatever the current rate is. So I point that out because we get that question quite a bit. It's still important to us, but we do this on purpose. It does limit. Now, the downside to hedging, guys, is it's going to limit some of our upside. And as Fred said, the good, the bad, the ugly. So if prices go from 80 to 120 to 160, and I'm being crazy here, but if prices really go high, this fund is not going to do a 3, 4, 5 to 1 return profile, right? It's probably going to be more like a 2 to 1, maybe a 2.5 to 1. And the reason is because, for better or for worse, we're hedging that risk out. So if prices do go crazy high, we're still getting our hedges at 70, 80, right? So we could have a paper loss in that scenario. But I point this out, guys, because it's an important part of our structure. Our capital base is so risk averse. If they can take the downside out, right? If they can have that downside protected, and they can have some participation in the upside, right? They'll give up a little bit of the up if they can give up all the down. And that's a big part of why we structured these this way.
Yeah, and it's actually, Fred, one of the major reasons we added you to our playbook, and thank you for accepting us, because it's a two-way street. We can't sell something that they don't want us to sell, and we can't sell something we're not allowed to sell. But we are looking at the horizon. The next 6 to 16 months will probably be historical with no matter who wins, the other side's going to hate it, and you don't know how that's going to play. And the last time there was a presidential election, we had a black swan event of COVID. I don't know what's on the bingo card. So by just managing the risk down, the upside takes care of itself, and getting income that has nothing to do with the stock market. Oil can't go away in our lifetime, I don't think, and definitely will not go away in the next 10 years as this thing's cashing out and coming back to us. So that the feature is a benefit. This flaw is a benefit. That we picked this fund because of the hedging, not in lieu of it. So the hedging comes with the fact that you can't have everything you want, because we all want unlimited upside and no risk. And that if you figure out how to do that, I'll come work for you and we'll take over the world. Until then, we got to deal with reality. And the reality is we're all going to still need energy. AI needs twice the amount of energy that we currently have, regardless of who's in office. Technology is taking over, Internet of Things. Like, the world is becoming way more energy dependent because everything plugs into something. It's
interesting too. You're right, because it's, the internet really is going back right to when you and I were younger, but that really used quite a bit. And then the next wave, like crypto, I mean, that was crazy. And then now to your point, look at AI, right? So every little new technology, it's an exponential increase.
Yep.
And the crazy part is, and you can look at, not to go all macro, but when we're looking at the world itself, right? So we use about 22, 23 barrels per person per year in the US. That's here, right? And we're at one end, we're at the very right end of that bell curve in terms of two things. Consumption of energy, right, is the first, and quality of life. That's a 1-to-1 correlation. That is literally almost a 1.0 correlation. Energy consumption and quality of life. And I'll give you an example, because the further down you go, Mexico, 6 or 7 barrels per person per year. I don't know if you've been there lately, but not exactly what I call quality of life. India, China at the other end, and about 1 barrel per person per year. And Africa is almost zero. It's literally not even on a graph, because there's 2 billion people there. So we want to be aware of that, right? The more that we grow as a species and population, you're consuming energy from the day you're born, and everybody wants a better quality of life. So I think all of those things are pointing to, at least maybe not crazy high, but at least somewhat robust and pretty stable energy prices.
Yep. And so when we're talking about your fund, can you walk a little bit about the investors and whether they're GPs and whether there's liability and how do you mitigate that? And obviously I want, my clients and even friends of our clients, everyone on the call, what are the costs, all that stuff. Feel free to tell them everything, because I want this to be an education on how these things are funded. You raised and deployed $4 billion. So that's $4 billion that saw the fees, saw the risks hypothetically, and still did it anyway, because the upside was higher than not doing it. So I'm not scared of fees. I don't think anyone should work for free, including you. So walk us through a little bit about what, when any of our clients buy ExxonMobil, they're not getting a write-off. So walk us through a little bit of the structure that allows the write-off. Has some caveats that I know you guys address. I want to make sure that the investors know, because I don't want them Googling it or ChatGPT. And it's like, oh, you're going to be a general partner. You're going to be,
No, that's a really good point, right? Which is a phenomenal discussion point, because, we can't dismiss what that definition is, right? So general partner, what does it mean? Well, it means you have risk. That's not like a limited partner. Your risk is what? If you put $1 into a limited partner, your risk is your $1. For a general partner, it's theoretically above and beyond that, because that's just what that's the definition of it, right? Now, I'll also add this: pushing 40,000 investors. The amount of investors that have been exposed or have had, because they were a GP, they were breached, right? And they were exposed, zero for 40,000. So when someone say, what's your top 5, 10, 500, risks in these, the GP discussion isn't even close to anywhere of those. And that's exactly why we've had 0 and out of tens of thousands of investors. And that's only because of the style of operations we do, right? And it's not even just us. The way that these assets are syndicated, right, especially for the domestic onshore, we've never seen a case that went to court where the GP was exposed, right? Now, it doesn't mean it can't happen, right? Your lawyers, Murphy's Law, I get it. But because of those concerns, we do have several different protection mechanisms embedded, right? So like having 9 figures of insurance that we carry. So we pay Chubb so much money every year, right? Just to make our partners more comfortable. It's also why we corporately indemnify, right, all of our investors. All right. So basically what that does is it puts U.S. Energy in our several $100 million balance sheet in front of every investor if there was a threat or a risk to them. And then the final piece, and then I'll move on to the fee part. The final piece is you're a general partner for a short window. So you have this theoretic risk for 6 to 12 months, right? Because that's when you're converted to a limited partner. And because of that, that's kind of why we get very comfortable with it. If we were doing exploratory drilling or offshore or something that just carries a lot of inherent risk, this is a whole different discussion, right? In terms of, but we're on the other end of that bell curve in terms of risk and what we do. So that part tends to be a smaller part of it. But you raise a good point, right? It's very important for investors to look at terms and deal structure. So for ours, we do have a preferred, the ability to have a preferred return after investors meet certain thresholds. So investors for us have to do for us to earn our carry on the back end, investors have to see a couple different things. They have to see, and I mentioned this a couple slides ago, it depends when they come in, right? Investors that came in early got a 20% preferred return. Investors that wait till December, or even if we're open, call it November, they'll get a 12% preferred return, right? So meaning the company turns on fees at different points depending on when they come in. And the other part is that they have to get all of their cash on cash returns back in a specified period of time. So there's a few different hurdles we have to do to max out our carry. And it's all aligned with, so between investors needing to hit metrics first, and don't forget, we've got 9 figures of our own cash in this thing, right? Between those two things, we feel it puts the investors front and center in terms of that client-centric structure. And pridefully, some of our biggest partners use it with their biggest clients because it's the leanest cost structure in the energy space in the nation. And so for that, it's been something that's worked very well for investors. And we just believe that very much. If you take care of the investor and you offer good deal structure and sound economics, you'll make money over time. But because of our scale, we don't have to worry about that. We're not trying to design little profit centers and revenue streams for us. These funds are very synergistic for other lines of our business. And overall, they're something that has done really well for investors. But by no mistake, if you look at our investments, I mentioned $200 million this year, $130 million last year, $90 million the year before. Our biggest revenue source, our biggest EBITDA generator is actually from the funds that we sell to investors. So a lot of alignment there.
And all 3 of these flavors that you have, our job with our clients is to figure out which one fits. So I know we're throwing a lot at people. This is not a one share class fits everybody. A lot of people want to reduce their high W-2 income. They're in the general partner side. Other people have specific other issues. And so U.S. Energy has the limited partner side of the share class, and LL. They're all doing the same thing underneath the hood. It's just what's the structure to get the client the best squeeze, juice for the squeeze. And they're going to have similar fees. And they're at the end of the day, if you had to describe the differences in how the money is deployed, Fred, is it the same? That it's deployed the same way? It's just the structure is these 3 structures, so
it's deployed the same way. We do have different share classes, right? So to your point, the lion's share of what we do, right? They're general partners. 75 cents of every dollar that we raise in a drilling fund will be from general partners because they want those big upfront deductions, right? Yeah. And then from there, And the smallest piece is LPs. That's more passive income, passive deductions. That's really not useful for most people. But the other one is the LLCs. This is qualified, right? So what's fun here, and I'll keep it really high level because this may not be of interest to most people, but let's just say that you don't really have this big tax deduction that you need, right? You've got, say, a lot of savings and assets, but you're not making 7 figures anymore because maybe you're retired, whatever. Well, there's 2 things that are cool. One, if you were to find an investment, and I'll explain why that could make sense, you don't need a deduction, but maybe Fred over here needs a deduction, right? So I can take all those deductions that you should have got because you put money into it, and I could what we call functionally allocate it over here to this investor. Because if investor A comes in with qualified money, I'm not allowed to give him a deduction. I can give it to investor B, but investor A gets something else, and I'll walk through that in a second.
And this slide is for my CPA to rock Greg's world, because I love showing him things that he may not have seen before. And this, if you can walk through this, Fred, this is really cool.
So one of the funnest parts of our job is it's not even here shell and returns and all of this stuff. It's how do you get the elephant through a keyhole, right? How do you put on that tax planning hat and think like a client? Because at the end of the day, investors aren't going to care about Fred, US Energy, and all this stuff. It's like, I have a problem, and in our world, it's a tax problem, right? How do you go out there and fix it, right? Or how can you make it better? One of the ways, and think about investors that over time have built up significant positions in qualified accounts, right? Something like 75 to 80 cents of every dollar out there is in some kind of a qualified account, 401k, IRA, whatever. Now, the challenge, and Fred said this at the beginning of the call, right? Where are tax rates going on a forward basis, right? Whether your timeline's in 5 years, 15 years, 45 years from now to retire, where are tax rates going? And we all know that's only one way, right? What if you can stop playing that game, right? So instead of having to have more and more money in savings because they're just going to take more, what if you can go and structure and move dollars from your pre-tax account to your tax-free account, and you don't really necessarily have to pay a lot of tax to do it? And here's one example. So if we were to say, and this is a $300,000 example, guys, don't worry about this. You'll see 100K position minimums on our stuff. I don't care. If someone gets the best tax bang and they need 46 grand, not 150 grand, perfect, right? We want someone to maximize so it's less about the dollar amount. But let's just get back to this example. At $300,000, if that was your IRA, or maybe you've got $3 million in an IRA and you just want to look at maybe doing a piece, over time, slowly, systematically converting. If you want to convert that to a Roth, well, anybody can do it, right? They took these rules away back in 2010, 2011, where it doesn't matter how much you make, you can convert anything. But now you're incurring a tax bill. So you convert 300 grand into a Roth. Congratulations, you have 300,000 of ordinary income this year, right? How many people want to sign up for that? Nobody, right? However, what if you have what if you can take that $300,000, put it into an asset that has a value that by design, now this is important, this does it on purpose, for a short period of time, by design, that asset shows a value that's highly suppressed, call it 50% or so, before it goes back up. So in other words, what if your dollar looks like 50 cents? In this case, what if your 300,000 looked like 150,000? And guys, these are real numbers. We did this last year. Our drilling fund on $100,000, it didn't show up as 50 cents. It showed up as 39 cents. So that 100 grand is now 39 grand. And guess what these guys are doing? Because in October, when Q3 is over, these values go back up, right? And I can go through the PV10 calculations of why a dollar's down here and all of this, but we're required to do this. And it happens to work out for investors. So now, guess what they're doing, right? All these people that put 100 grand in, it's 39 grand. They're doing Roth conversions because they still have 100 grand. And if they're seeing 50% of cash flows, like I talked about earlier, that's 50% on 100, not the lower amount, right? So they're still so now when they're doing that, they're Rothifying these assets. And by the time that that tax bill is due, there's cash flow kicking in. So it's a really fun way to Rothify. And even if maybe there's smaller amounts, again, we don't care, but it's just a fun way for those that are looking to take dollars off the table, stop playing the game of the government where rates are only going up, get things into that elusive tax-free account, but do it in a way that mitigates the tax hit, right? So bottom line is these strategies can reduce your tax bill by 50% just because of how my company is required to show values. And by the way, if you want to take that 50 cents of a tax bill down to zero, right? Fred can hook you up with a drilling fund that makes that a wash as well to take this tax bill all the way to zero. Yeah. So that's
and
just
for the non-qualified money. Your statement does not go do this. This is just for the qualified side of the house. I know people are thinking, oh, I don't want it to go down and go back up.
Yes, exactly. Exactly.
So, I mean, this slide's for you, Greg, and anyone else that has a lot of money in the IRAs and again, the IRAs were sold, in the 70s and 80s that you're going to be in a lower tax bracket in retirement. That didn't happen to anybody, and it ain't going to happen to you. The only clarification, the only thing Fred ever said wrong today is no one in my office is waiting 45 days to retire. I would not, or 45 years to retire. I would not be doing my job if that was it. So we got some questions. What other slides? Let's see. This is, and again, we'll send all the participants. We'll send you the slide deck. I do want to get to where we get to look at each other. There is a ton of information. It is easy but complicated to legally avoid the IRS, burdens that they're putting on us for taxes. Right. The hardest thing for most people to do is two parts. Being accredited investor, you guys need to do that before you come here. Again, we help that happen, but these investments are only for accredited investors, and that's not everybody. Then the second part is having access to this. So it is not something, a lot of these funds are not sold at the big firms. There's never going to be an oil and gas fund at a Vanguard because they just don't deal with accredited investments. So it's really a niche market that's huge, but not everyone can get in and not everyone can play. It's easy once you see it and understand it. And it's our job to work with Fred and his team to say, okay, here's the situation. Here's the assets we have. What's the best way to mitigate the taxes? If they have a tax person, and most of them do, we bring them in because I want the tax person is going to be the person that's going to say, what the hell is this? Or, oh, what the hell is this? And if the sooner we bring them in, the more they're likely to want to participate. And the good tax guys say, hey, thank you for doing that. Can you do this for me? Can you do this for my other clients? And so there's a fringe benefit of doing something like that is not necessarily, meant to be self-serving, but it doesn't hurt. We did get some questions, and I'm going to turn off sharing so maybe we can see each other. And that way I can see the there we go. Hello, I exist. There's Greg. There's Fred. Look at us handsome devils. All right. So what are some questions? I think we got a bunch. I got friends in here, and I know I want questions. So we talked about GP investors covering liability. Can you walk through a little bit, Fred? Let's say you put 100,000 in, the oil price collapses. How much of that 100,000 in is hedged? All of it, some of it, 40% of it. Walk me through that.
40, yeah. I mean, so it's 40 of the overall production. That's the short and loose answer. Sure. I mean, so technically we use costless collars and swaps, right? So mostly collars, swaps is there as a supplement, but the early production, the lion's share is hedged. We hedge more early, less later, but it works out to be about 40%. And the reason is with our structure, that's all we have to hedge to protect your first dollar back.
Yep. So, and when we're talking energy, oil collapsing, it doesn't stay to zero, it doesn't collapse forever. So it's just that your income would go down before it comes back.
Yeah, even COVID, right? Think about the most cataclysmic Armageddon thing we've ever seen. I get this all the time. Oil went to negative 36. No, it didn't. It went to $12. The futures market, the paper went to negative 30 because no one wanted to hold it. Oil never. So over time, yes, that's exactly right. And the downside, and I think I hit it, but I'll make it clear. and for those of you that are, kind of get into the weeds on a prospectus and balance sheet information, you'll see this in our books, especially from 2 years ago. We took a derivatives loss when pricing went up because we were still hedged, right? Now that's the better or worse scenario, but it's just more of that protection mechanism so that when we have that, we know that we have a guaranteed, if prices go high, it gets called away. But if prices go too low, it becomes a put, and we can get, that strike price of say 71 on the low side. Even if the market's selling it for 46, we're still getting 71. Yep. Right. And that was the whole concept.
Yeah. And that's, so from a minimum standpoint, 100 on the table, 50 is what we tend to see common sense. Again, if Greg says, hey, I absolutely need 29,000 for one of my clients, we're not going to say no. Fred won't say no. Nope. But in general, it's not worth it for less than 50. There's a ton of paperwork with any alternative investment. We don't mind doing it. Fred doesn't mind doing it. Just is
make it count, right? You could be,
does it make sense
for
you?
You could have been the one guy that saw NVIDIA before it popped, but if you only bought 3 shares, who cares, right? Make it count for what you're trying to do. And
then for the maximum, we are required to keep it around 10% of a client's liquid net worth. So if you're worth $1 million, we're talking $100,000 going into something like this for this year. And so that's something that, has to be matched out. Some of our clients are repeat offenders, repeat investors, because every year they're making good income they need. And so as their net worth goes bigger, and there's 2 parts of accreditation. I want to make sure I'm clear with it. One is the $1 million not counting your house. The other is income-based. So if you're individual, it's 190, individual 190, and joint is 300,000 if you're married. So slides are going back to everyone. I wanted to keep this under an hour, and I think we're pretty good there. If you had a question and wasn't answered by anybody, please reach out to us. We have the answers. This Fred and even Greg, if you need him to come in, we'll talk about anything and kind of look at your case. Greg, before we let you go, do you have any questions? Do you have anything from a CPA standpoint? Because you have nothing you have no obligation to me or to the other Fred. Do you see, how often do you see this strategy? My clients with you, obviously you see it a lot, but in general, is this still a niche play, or is this starting to get some traction in the real world because we got real taxes for real people?
Yeah, it's sort of all over the place. You gotta, you gotta like the investment, and there's a lot of variation amongst different oil and gas investments. One question I do have for the other Fred, to tie in with the estate planning, especially with the value, dropping in year 2, is can you transfer the ownership interest, or is that prohibited?
No.
Okay.
So here's one in that there was a slide, right, that had GP, LP, LLC, and, had all the different events like RMDs, Roth IRAs, all the different triggers. So one of them, right? So I'll just give you one final one, right? You can use it for RMDs as an example, right? So how many clients love taking RMDs, right? You've done really well, right? You've put away dollars. You don't need the cash, but you're that magic number, and now you've got to go. It's a forced tax bill. So what you can do is call Fred, right? And you can use a drilling fund, right? So if your RMD is, say, whatever, it's not $1. Let's just say it's $1. He puts that $1 into a drilling fund, 90% of that tax. So for every $1 of your RMD, put $1.10 in, right? And make it a wash. So your tax bill goes away. But so Greg, back to your point, now what you can do, now it becomes not just this little RMD planner, but that same investment can kind of become a gifting tool, right? So think about it. The same dollar that's doing both of these things. The same question for the same audience, right? How many people love the idea of giving and gifting dollars to their heirs, right? On paper, sure. Who actually does it? How many wealthy individuals like giving large sums of cash to their kids? They just don't do it, right? Maybe they'll be foolish or whatever, but it stems a lot of control. So here's what they can do though, right? That $1 that's now in that drilling fund that they got a deduction on, they can turn around and gift it to their heirs at that discount, right? So that $1 at 50 cents, 40 cents, 30, whatever, they can use that lower value and gift it out of their estate, and there's no recapture. So they get to keep all the deductions, and now that child owns the cash flow from that future asset. And the best part that they like about this is that it's not liquid, right? So forget the dollars. Let's just put a real case. If it's a $200,000 case and the parents did this with little Johnny and Susie, little Johnny can't call Fred at US Energy and say, where's my $200,000, right? Instead, what is that child getting every quarter for the next 10, 15 years? It's a wealth creation tool. So it's back to your point is, yeah, you can use the lower value for gifting and there's no recapture on the deductions. It can be a really flexible, just all in tax and planning tool.
Good question.
Good. Yeah.
Yeah, great. I like the face Greg made. Like, that's the face I'm like, I think I know people. I think I have people. All right. Thank you very much. I'm going to keep this under an hour. We will be doing more of these with other, other sponsors, other ideas. We've used and will continue to use US Energy. They're the highest tax deductible. They have all that flexibility. So if any of this sounds like it might make sense, reach out to your strategist here. Happy to sit down. And if it's not a good fit, not only will we say it's not a good fit, Fred will say it's not a good fit. The Gregs of your world should also say it's not a good fit. For most people, if they have a tax bill, they have cash to apply to the tax bill. You have a choice: pay Uncle Sam, or put it in something like this, or put it in this and not pay Uncle Sam as much or anything, and then get income. Because even if you pay Uncle Sam, they're not giving you the returns that US Energy is. So with that, I would like to thank everyone and this is our first time. So if you have any ideas, I would like to next time have a video and the slides at the same time, because I think at some point it was just the slides and, so we are going to get better every time. This is our first. Hope it didn't look like our first, but thank you very much for everybody. Fred, thank you for your time. Greg, thank you for your time. And for the audience, thank you for your time and questions, and reach out to us if you need anything else.
Perfect.
Take care, everybody.
Guys. Take care.